Hello, and thank you for joining today's webinar, R&D Credits for Manufacturers. Before we begin, let's review a few housekeeping items. First, at the bottom of your screen are multiple tools you can use. All of the engagement tools are resizable and movable, so you're welcome to move them around to get the most out of your monitor space. You can expand the slide area or maximize it to full screen by clicking on the arrows in the top right-hand corner. If you have any questions during the webcast, you can submit them through the Q&A engagement tool. We will answer these during the webcast, but if we run out of time, it will be answered later via email. A copy of today's slides and additional help materials are available in the related content tool. In addition, we encourage you to download any resources or links that you may find helpful. For the best viewing experience, we suggest closing any programs or browser sessions running in the background that could cause issues. If you have additional questions to some common technical issues, in the help tool at the bottom of your screen. If you'd like to receive CPE credit, you must stay in the session for 50 minutes and complete 3 poll questions. We will email you a certificate after the session. Once you leave today's webinar, you'll receive a survey on the presentation, and we'd appreciate providing your feedback. You will also receive a follow-up email within 24 hours with a link to view a recording of today's webinar. At this time, I'd like to turn it over to Jim.
Thanks, Michelle. Welcome, everybody. Happy New Year. Welcome to our first, the Manufacturing Solutions Group first webinar of the year, and it is a very timely and very important one. Today, we are going to talk about R&D credits for manufacturers. To give you a little bit of history for those who are unaware of the R&D credit, the R&D credit was first instituted in 1984. At that time, it was not a easily attainable credit. Now, there were some hoops that you had to jump through. Over the years, it has been liberalized very much, and has been liberalized to encourage research and development, encourage U.S. companies to improve products and processes. And it's been great. It's been a great tool for a number of our clients to reduce their tax bill and be able to improve their products, improve their processes. Recently, there's been a change, a major change to the research and development tax credits. And we're going to talk about that today. And Nick Demetrios, who is a partner in our tax advisory group, the HBK Tax Advisory Group, and is our liaison, is our HBK Manufacturing Solutions Group liaison to the Tax Advisory Group. Nick is very well versed on the research and development credit, and I am going to turn it over to him and let him talk about it, but I think you are going to find that this is a very important topic that we're going to discuss today.
Thanks, Jim. Yeah, this is a major change to the expenses and the way that they're accounted for tax purposes in being deducted. You still have the R&D credit, but this is a revenue raiser that was put in place by the Tax Cuts and Jobs Act, and we will get into that in detail. So this slide here is a attendance confirmation. So please check that box. And we'll give you a moment to do that. Okay, what we need to talk about first is when we're talking about the R&D credit. The R&D credit is governed under Section 41 of the Internal Revenue Code. The expenses that are research and development expenses are governed under Code Section 174. And all Code Section 41 expenses are 174 expenses, but not all 174 expenses are Code Section 41 expenses. And we'll get into that and why that's important. Industries, though, that are going to be dealing with this situation of the change in how we have to account for the expenses related to the 174 deductions that are going to be impacted most are these ones listed here. This isn't an all-inclusive list, but manufacturing is high on the list. Software development is highlighted because there are some changes for software development that are going to treat software expenses as 174 expenses and change the way that software development costs have to be amortized or deducted going forward, and we will talk about that. But manufacturing is an industry that has benefited heavily from research and development credits and expenses. Under the old rules, you were basically allowed to expense all your 174 deductions currently. However, there's significant changes to that from a capitalization and amortization regime that we now have to follow. And again, we'll get into this in more detail, but just because something is listed on a balance sheet, on an income statement of being a research and development cost, it may not be something that we have to consider for this purpose. But again, anybody that is currently taking an R&D credit has 174 expenses. And we're going to have to take into consideration those 174 expenses, not just stop claiming R&D credits. This is a change to these expenses and the amortization and the deduction of these expenses unless Congress changes it. And we will talk about that a little bit. But let's go back and talk a little bit about some of the history of this, okay? So R&D costs that are incurred in taxable years beginning after December 31st, 2021. So that would include calendar year 22 and fiscal years beginning in 22. Not anything that was beginning prior to 22. Has to capitalize and amortize their Section 174 research expenses under the half-year convention using a 5-year amortization timeline, which, because we are under the half-year convention, actually turns out to be a 6-year timeline, and we'll show you that in an example a little bit later. If you're conducting foreign research, that has to be capitalized and amortized over 15 years. And again, this is a major change from being able to deduct these expenses currently like we've always been able to do prior to 2022. All right. Any costs now that are incurred in connection with software development, which was handled under Code Section 167, is now going to be handled under 174 and considered a research expense and will have to be amortized over 5 years. This could be a big detriment to software developers who are taking current expenses for the development of their software under the 174, under the old 174 regimes, where they could take advantage of deductions, net operating losses, carry forwards, while they are in the process of developing software and not earning revenue on it. This could be a change where they are potentially put in a taxable income situation, which is, again, there is, and I will say this probably 50 times during this presentation, there is bipartisan support to change these rules. There's House bills out there right now to change these rules. It's just that no traction has been developed to get something like this passed. There was some inklings of having it passed in some of the different, there was some thought that in the omnibus budget bill that was passed right at the end of the year, that they might include some tax extenders and tax savings in there, but that didn't happen. So now we're faced with these rules being implemented for 2022 and hoping that there's a retroactive change in order for us to get out of having to capitalize and amortize these things.
And one of the things, Nick, just to jump in on this, this is really just a tax accelerator. Over the course of time, it's all going to equal out. It's just accelerating the tax now. And not that makes it easier on anyone, but it is just a tax accelerator.
Yeah, it's the way they got the budget math to work when they passed the Tax Cuts and Jobs Act in 2017, effective 2018. They needed a revenue raiser to kick in and generate a few billion dollars. I think it was close to $100 billion that this was scheduled to increase tax revenues by on the back half of the Tax Cuts and Jobs Act. I think when it was implemented, everybody kind of thought, well, when we get 3 or 4 years down the road, this will just get changed or delayed, because again, like you said, it's just a timing difference, and they work in 5-year increments. So if they're working in 5-year increments, we could find something else to offset it, but that hasn't happened yet, unfortunately. So we're stuck with these rules right now for the 2022 filing season and 2022 tax years for people that have 174 expenses. And like I said earlier, just because you aren't taking the credits, the Section 41 credit, doesn't mean that you don't have any R&D expenses. Okay. I was just reading that question there in the bottom, but I will we'll look at that in a moment. All right, so what are we supposed to do here, and how are we supposed to change this and adapt to it? Again, everybody thinks that this is going to change, but the IRS is operating as if, it hasn't changed and it isn't changing, which is what they should do, and they have provided guidance under a couple different revenue procedures, but the latest and greatest one that superseded the last one is Proc 2023-11. And it's the one that gives us guidance on how to institute these changes. However, there's still a lot of unanswered questions that are out there, which we will talk about when we move through the remainder of the presentation. But keep in mind, too, that under the old rules, when we would take an R&D credit, we would have the option under Code Section 280C to take a reduced credit or a full credit. If we took the full credit, the R&D expenses that were used to generate that credit had to be added back to taxable income. If we took the reduced credit, you didn't have to do that add back. Now the way the add back will work is if you do take an R&D credit, the only thing that will reduce your capitalized R&D expenses under 174 is if your R&D credit exceeds the amortization that you would be taking on those expenses. And you'll see that in an example later on. A lot of this word salad stuff is hard to understand, but I'll show you a good example of it a little later on that'll hopefully drive it home a little bit. And again, keep in mind, and I'll say this again throughout this presentation, is 174 is much broader than Code Section 41. So just because we are taking an R&D credit and tracking our Section 41 expenses doesn't mean that there's additional expenses out there that we need to also capitalize and amortize under the 5-year period. Here's an example of Code Section 174 and Code Section 41 expenses. And like I said earlier, all 41 expenses are 174 expenses, but not vice versa. And here's the thing. We've always told taxpayers when we're doing these credits that it is paramount and very important to get an R&D tax credit study done, because the tax courts have held that appropriate substantiation has to happen in order for you to be able to take these credits. And there's all sorts of things in case law and regulations that have said, this is what you have to be able to show us in order for you to be able to claim these credits. They are liberalized, like Jim said, but if you don't have the appropriate substantiation, the IRS is going to kick out your credit. So again, with this rule change, is every taxpayer faced with having to get an R&D credit study or an R&D 174 expense study to determine the appropriate expenses that need to be capitalized and amortized. It's not as simple as just pulling numbers off of a P&L and thinking that they're R&D expenses. You actually have to go through and do an analysis of those expenses and talk to the taxpayer, talk to the clients, and see what expenses and what activities they may be doing that qualify under 174. Just for clarification, in order to take what you would use to take your R&D credit are Box 1 wages, which are the most important wages that have to do with your experimentation costs. Wages are usually the largest component. And then you've got contractor costs, which you can get 65% of, some computer rental or lease, and then raw materials or supplies that are consumed in your experimentation costs. But if you go over to 174 column, which again, I ended that, is how do we determine without a study like we normally would for Code Section 41, all of your 41 expenses are thrown in there, plus your gross wages and other payroll costs, overhead, which again would be governed under Code Section 263A and how you're allocating overhead in your manufacturing process, supplies, occupancy costs, patent costs, software licenses, utilities, and again, this isn't an all-inclusive list. This is just a list that of common things that you might have to capitalize into your 174 expenses, and it is also much larger than the subset of qualifying expenses under Section 41. And so why does all those indirect costs matter? And again, if you're getting R&D credits, you're most likely getting an R&D study, or you're having some work done to determine what your qualifying expenses are. If you're getting that done, you're tracking those Section 41 expenses, qualified research expenses, QREs, but you're not tracking your Code Section 174 expenses, again, because 41 is simply a subset. And again, just because we might see R&D expense on a P&L, or we might not see R&D expense on a P&L, doesn't mean that we don't have 174 expenses. Also, if we're not claiming an R&D credit, we just can't pretend that we don't have 174 expenses that are subject to this capitalization and amortization over 5 years. Again, the scope and existence of this 174 is in need of major guidance. Under the old regime, you would just currently expense your 174 deductions because you didn't really care. You could make an election under the old regime to capitalize them and amortize them over 5 years, which was a straight line method. And some people would do that if they had expiring NOLs, or if they had other tax credits that were expiring that they were trying to utilize, or if they had some AMT. R&D used to not be subject to offsetting AMT, so some people might make those elections in those old rules. Even though we don't have a corporate AMT anymore, you don't typically see a 174 election that would be capitalized. But now we are faced with doing it regardless of how we expense them in the past. And even if we have that 174 election in place where we were amortizing it over 5 years on the straight line basis, we're still going to have differences because the 174 rules now require a half-year convention, so you're going to have a different starting point.
Nick, I think a key thing to point out here, as everybody can confirm their attendance there, is that even if a company has never claimed the R&D credit, they have 174 expenses. They can no longer be expense. They have to be capitalized and amortized.
Correct.
So this, like you mentioned, it's really broad. It's really, the scope of this is really broad. It affects companies that never gave any thought to an R&D credit before.
Exactly. And that's the revenue raiser side of it. And again, it's a timing difference, like we mentioned earlier. You're still getting all the expenses, but you're spreading them out over a 5-year period, which I'll show you in an example in a little bit, that can really increase your tax liability in current years, accelerate your tax liability in current years. Another thing that we really don't have any idea about are these contractor costs, the 65% contractor costs, which you can take as an R&D credit if you're paying someone to do research and development for you, and you're the one that is accruing all of the risk in that, and regardless of whether or not that third party fails, you still have to pay them. You can deduct 65% of your contractor costs, and those can be included in your R&D credit calculation. It would be considered also a 174 expense. And so in that situation, what do the contractors do? Are they faced with those costs that they're performing for us? Are they faced with amortization too? So they're going to have revenue recognition and a 5-year amortization on a project that they might be doing. Again, this is something that the IRS has requested comments on, but we don't have any guidance on it. And another thing too is these 174 amortization deductions are going to likely increase our 199A eligible income. Our 199A eligible income is the small business deduction. So we will have some additional upfront deductions, 20% reduction of taxable income under 199A. But again, at the back half of that, it's going to shrink those deductions. So there's other credit items, other expense items, other tax benefits or detriments that are reliant on taxable income or adjusted gross income. And again, we are going to be modifying and changing those numbers because now we have to amortize over 5 years our 174 expenses. Software developers, current treatment. Software right now, typically software developers under this Rev Proc 2000-50 have to amortize their expenses over 36 months or 60 months from the completion date, or expense them in the year paid and incurred, which is typically what everybody does, other than electing to amortize them, is they're going to expense them. We have software companies that expense their software development costs and create net operating losses or create other losses, or have used those expenses to generate and stack R&D credits until they're profitable. But now they're going to be faced with amortizing these over 5 years. Again, we could be in a situation where a software developer early on in their process could potentially have taxable income before they're even generating meaningful revenue from their software until it's ready for public consumption. So this is a problem. And again, this is all kind of going in against the whole spirit of the R&D credit and the deduction of 174 expenses. The whole reason why this was put in place, and Jim mentioned this earlier, was to incentivize U.S. companies to keep high-paying research and development jobs and expenses here on shore and to utilize those costs. They were incentivized to be experimental, incentivized to create new products, incentivized to keep those high-paying jobs in this country. And now we are creating a timing difference and a detriment, and instead of having the carrot and the stick, this is really just like a stick for the next 5 years until the R&D credits would start to catch up. And I'll show you an example of how that works. But this tax acceleration, and again, which is why there's bipartisan support to change it, even though it hasn't happened yet, it's going against the spirit of the R&D credit and the R&D expenses in and of itself as to why they were put in place in the first place. So here's a simple amortization example. Okay, amortization happens straight line under what we call a half-year convention, meaning no matter when you incur your expenses, it's treated as if they were incurred in the middle of the year. So let's say for 2022 you incurred $1 million of 174 expenses. Your amortization for year one would be $100,000. 20%, okay, if we were amortizing this over 5 years, you would think, oh, well, it's 20% per year. But under the half-year convention, the first and last years are only 10%. So in year one, we have an amortization rate of 10%, 20% through years 2 and 5, and 10% in year 6, which means that this $1 million of expense doesn't get fully recognized and realized and benefits derived from until 2027, which represents the timing difference in the years. Now let's stack on our R&D credits on top of that. All right, let's assume, and I didn't put in here how we calculated the R&D credit, but let's assume that the R&D credit under the reduced credit, using the 280C, meaning we're not adding back any R&D expenses for tax purposes, for M1 purposes. Let's assume that we have an R&D credit $55,300. And we have $1 million of 174 expenses each year, which we would normally be just expensing and buzzing right along. Well, what's going to happen in year one on this $1 million is we're only going to be able to take $100,000 of expense, which means that instead of $1 million deduction, we have a $100,000 deduction and a $900,000 add back for tax purposes. That $900,000 add back under the current marginal rate of 37% creates additional income taxes of $333,000. So even if you are taking R&D credits under Section 41, trying to offset this, the offset is not nearly enough in year one, and we still end up with a net tax increase of $277,000. That is extraordinarily significant. In year two, we have another $1 million expense that we would take a benefit from, but we have $300,000 of amortization, $100,000 on the 2023 $1 million, $200,000 on the 2022 $1 million, for a net increase of $700,000, resulting even with an R&D credit of a tax increase of $203,000. So you can see as I work through the math here what ends up happening. It is not until years 5 and 6, assuming we still are paying the same R&D expenses as we are every year, that this starts to turn around and we actually receive a benefit. Now, if we're continuing to spend on R&D, after 5 years, we're going to be caught up, and this is not going to be an issue. But for the next 5 years, you have accelerated hundreds of thousands of dollars of tax on the $1 million of R&D expenses that you would otherwise be able to take as a deduction and incentivized for spending. This total tax increase over these 5 years is $593,000. Okay, well, technically 6 years because of the way we have to amortize that out.
Now, if you take that out 10 years,
yeah,
it's going to net to zero.
It's going to net to zero,
right?
Yeah,
but you can see the impact of those early years.
Yeah,
that is big.
And a 10-year cycle is not a short cycle.
No.
You know, you're talking about most businesses aren't operating on 10-year cycles on tax deductions. And I wouldn't want to tell someone, yeah, spend this $1 million on R&D and you'll get a tax benefit from it in 2033. So nobody would be on board for that. Here's an example with not taking the reduced credit. And again, normally under the old rules, we would take a reduced credit all the time. We would want to take that because we would have to add back $70,000 of R&D expenses for tax purposes unless we took that reduced credit. But as you can see, the difference between these two, this resulted in a $593,000 increase. This resulted in a $505,000 increase. The R&D credit is $70,000 in this situation because we're not taking the reduced credit. So it actually benefits taxpayers opposite of how the current rules would work. I'm sorry, not the current rules, the old rules, because we are in the current rules. How all those old rules would work, it's opposite where we would take that reduced credit. You're better off not taking the reduced credit because your only add back if you take the reduced credit is your only add back if you don't take the reduced credit is the excess of the R&D credit over the amortization, which in this situation we wouldn't have at all. Again, and that is totally opposite of how we would normally function with this R&D credit. Now, and the other thing too that's out there that you have to consider is, a lot of states have their own R&D credit regimes, and a lot of states also have a lot of adjustments to how things would be handled for federal tax purposes versus state tax purposes. So we have no idea how states may decouple or couple from these rules.
A good point. Ohio, you get a credit against commercial. You could qualify for credit against commercial activity tax.
Yeah.
Since Ohio doesn't really have an income tax.
Yeah.
How does that?
You have no idea. We have no idea right now how that's going to work. All right. Confirm your attendance, please, as we continue to move through the presentation. So what's our procedural guidance? Again, I mentioned earlier we have procedural guidance under Revenue Procedure 2023-11, and it groups taxpayers into three different tranches. We have short year 2022 filers, and again, this would be people that are having a tax year beginning in 2022. Again, remember we said that tax year has to begin in 2022 in order to have these expenses be subject. We report amortizable costs on a form called 4562 in the tax return. On the second page of that form, there's a little schedule at the bottom where you list out your amortizable costs, you list the code section that you're amortizing them under, and how much amortization expense you're taking. So again, if any of these short period returns are filed before January 17th of 2023, which was yesterday, any short period returns, all we had to do in order to elect this method change, because it is a method change, all we have to do to elect this method change is to report the expenses on that part of the form and show how much amortization expense. For 2022 filers, calendar and fiscal year 2022 filers, we normally would have to file what's called a Form 3115, which is a method change. Anytime for tax purposes we're changing the way we account for a certain expense or a piece of income, we are required to tell the IRS what we used to do and what we are doing now. And file a form, a very arduous form, which is 8 pages long at least, which is going to include multiple statements and schedules. This would be an automatic change under Code Section 265, but again, you would typically have to file this as a 3115. What they've done, just like they've done in the past in some cases, is said, okay, you don't have to go back and recalculate your R&D expenses as if you've always had to amortize them all. All you have to do is change starting in 2022, which is called the cutoff method. You're going to change in 2022, and you're going to attach a statement to your tax return that gives the name and EIN and change number 265, the description of the tax costs that you're capitalizing, and a declaration of the method change for those R&D expenditures on that cutoff basis like I just mentioned. So all we're dealing with are the 2022 expenses. The statement also has to show the tax year and a few other things. I actually have a copy of the statement in the next two slides. But the problem with this statement so far is there's not any, other than the revenue procedure, there's not anything in your tax software right now for the tax preparers that are out there, or something, a sample of a tax form or instructions on of a tax form on how to generate this. So this is a manual statement that we're going to have to put in a lot of tax returns. Okay? We don't have to file a 3115, but it is a manual statement that would have to be put in any tax return that has 174 expenses. And I was on a webinar about this the other day, and during one of the polling questions, they asked the question of, it was all practitioners on the call, and they asked the question, what are you planning to do if the client is taking R&D credits? You're just going to amortize those credits and put your statement in your return. You're just going to amortize those expenses. If the client isn't taking R&D credits, are you just going to ignore this whole thing? Like you aren't supposed to amortize any expenses. Or are you going to go through and get a 174 study? And, it was going up the ring of how much you actually were willing to do to make sure that you're in compliance with this. But please note that this isn't something that we can just ignore. This isn't something that we can just say, yeah, we got 41 credits, we're just going to amortize those expenses. Or then it's not something that we can just say, I want to have, it's not like something that I want to say that we're just going to ignore it and pretend, stop taking 41 credits and pretend this whole thing doesn't exist.
And it's easy enough to identify the Section 41 expenses. Identifying the Section 174 expenses is going to be a heck of a lot harder. Mm-hmm. A heck of a lot.
Yeah.
Well, I shouldn't say it's easy enough. Let me just say that it's a heck of a lot harder to identify the 174 than to identify the 41.
Mm-hmm. Mm-hmm. Yeah, because it's so much more broad. And again, this is something the IRS has done over the past couple of years, past several years now at this point, is they put a lot of onerous on the tax preparers in order to try to calculate these expenses, to calculate different things, different capitalizable amounts, different add backs, and there's really no appreciation in these rules for how difficult this expense calculation is going to be. Now, post-2022 filers will have to file a Form 3115, and it won't be made under the cutoff basis. It'll be made under a 481A adjustment. But that's all the procedural guidance that we have out there right now. And here's a copy of the statement. I copied this right out of the revenue procedure. So if anybody needs a sample statement, a lot of tax research software, a lot of tax preparation software will prepare these statements, but we actually called our tax software preparation company and asked them, are you going to include this statement or put this in? And it's under a work in process right now, but because there's so much consternation around whether or not this is actually going to change, they have no real sense of urgency of putting it in at any point. Okay, so again, this is something that we're going to have to manually put in tax returns.
Or, and I think you'll probably get to this, we may hold off filing returns until there's some we may, returns we typically don't extend, we may have done and ready to go, but extend them and wait to see if anything changes.
Yeah, and then you're faced with your 2023 planning potentially changing. So we'll actually talk about that. That's a good point. And here's the back half of the statement. But again, you have to go through and list out the expenses that you're capitalizing. So it's just like getting a 174 study. It's just like getting an R&D credit study under Code Section 41, except we're creating this add back and not having to realize tax benefits for quite some time going forward. So, what are some recommendations? Just like you had mentioned, Jim. Plan to extend, if possible, those tax returns that have 174 expenses. In a webinar that I was on about this a couple of weeks ago, they had talked about the possibility of something happening in Congress, and they had kicked around dates like March, which is awful because most of these returns, any flow-through returns that are going to have this, you would end up with a filing deadline of March 15th, which means you'd have to extend most likely your personal return. You would be looking at potentially paying estimated taxes as if you wanted to avoid penalties and interest, as if you weren't going to get these deductions, which would mean extra cash out of pocket in the next few months, and then have your 2023 estimates be based on 2022 with the higher expenses, and then change everything if and when this is rectified. So it's definitely not an efficient process under what we are currently dealing with here. And again, like I mentioned earlier, we just can't stop claiming the 41 credit and pretend we don't have 174 costs. The thing that's crazy is you would like to think that R&D credit could help offset this add back, but it's just too large. You're normally looking at an R&D credit around 8% of what your expenses are on a quick and dirty calculation. And that is not going to overtake the 5-year amortization. But if you're not doing R&D credit studies, and you realize, wow, I have these 174 expenses I'm going to add back, really the only offset is to get an R&D credit study. If you're faced with adding these back, let's try to mitigate the damage as best as possible and get an R&D credit study. We can help with that. We have firms that can help with that. And again, that's one of those things we've always held out. And I mentioned this earlier. We've always held out. Get the R&D credit study to appropriately substantiate your R&D expenses and your R&D credit eligible expenses. So this is all the more reason to do something like that.
Well, and I think a lot of our clients that I've talked to over the years, when you initially talk to them, think, I don't qualify for that. I don't do research and development.
Yeah.
And as I mentioned, it's been expanded, liberalized over the years, that if you try to improve a product or improve a process, even if you're not successful with it, you've been doing, I use the example all the time, you've been making pens for 100 years.
Yeah.
You try a new way this year to make that pen, and you find out that new way is not better.
Yeah,
you have research and development costs.
Yeah,
and so it's like you said, because of this may make some people really look at, if they haven't previously claimed the R&D credit, to claim it to help offset some of this.
Like you said, people don't think they're eligible. Well, that whole thought process on eligibility may change now that you have an add back.
Yeah.
And again, it doesn't have to be something that, like Jim said, it's not something that has to be brand new to planet Earth. This is something that's brand new to your company, brand new to your example. I would like, brand new to your product, I would like to see an increase in those R&D studies in order to offset the added cost. But again, what could happen any day is that, again, I looked this morning and I looked again right before I walked into this room to do this presentation to make sure that something didn't come through Congress that would basically, we would have just had 45, 50 minutes to sit here and talk about current events. Or we could have just had a question and answer session on a potpourri of topics, but that hasn't happened yet. And again, I know that there's bipartisan support. It's good that there's bipartisan support. The AICPA has actually written letters to Congress on behalf. The manufacturing associations have written in letters on behalf of taxpayers to try to get this changed. It makes sense to change it. Again, like I said earlier in the presentation, it is against the spirit of what we're trying to do with the whole R&D system. And hopefully that we will see that changed in short order, hopefully before March. I would like to see it happen as soon as possible. Okay. All right. Make sure that you are clicking this next question for your CPE, attendance verification. And with that, I'll open it up to any questions.
I think we had a couple posed there. I guess you have to scroll down there to read them. Mm-hmm. The first question was, why can I just not stop taking the credit? If a taxpayer is upside for 4 to 5 years and that tax money could be substantial, why would I do this? How can the IRS enforce this? I'll let Nick answer that.
Yeah. Well, the only way that they could enforce it is by audit.
Yeah.
The one thing that I will say is if you have been taking an R&D credit and all of a sudden you don't have any 174 expenses, that could definitely be a red flag. I think that they will enforce this just like they do any other accounting method changes, and it makes sense to adopt it and do it now. If you were to get caught upon audit, they would take into consideration the entirety of the adjustment in one tax year. Even if you are a post-2022 filer and you have to do what we call a 481 adjustment, you're spreading these costs over 4 years and picking up income over 4 years under normal accounting method changes. It just makes a whole lot of sense to be on board with it from the get-go. As much as I dislike the rules and hope they change, what we may be faced with is the example I was talking with one of my colleagues the other day is when the Tax Cuts and Jobs Act passed, there was a drafting error in it for qualified improvement property, which basically excluded a whole class of property that had previously been allowed for bonus depreciation from bonus depreciation. We went through nearly 2 tax years before that got fixed. And what the IRS then had to do was create accounting method changes for you to go back and automatically switch off of it and take the tax benefit. What we could end up seeing is adopting these rules for a year or two and then having Congress change something, because again, it has to be, this one would have to be an act of legislation. The IRS couldn't just change it. And then the IRS be faced with telling us how to switch off this accounting method and take these R&D expenses. Yeah. And again, it's extraordinarily inefficient. but I can definitely see a set of circumstances where that's where we end up. But that's a good question. You know, it's always a change. It's always a question as far as, you know, how do we jump on this and what can we do to help the clients out as best as possible and make it as easy as possible. And I think we got to put forth right now, I would tell anybody, if we think that these 174 expenses are significant or material, we should extend your tax return.
Yeah. And that's what I'm thinking with my clients. Mm-hmm. To touch on the question that was posed, if I were the IRS, you know, let me preface this. We at HBK, we're going to do everything correctly to get you to pay the legal minimum in tax. Mm-hmm. If I was the IRS and I were to look at how to enforce this, remember what's coming up, 87,000 new IRS employees. Now, mm-hmm. Everybody's saying it's 87,000 new IRS agents. Well, it's not going to be new IRS agents. It's going to be new employees. Mm-hmm. But included in that are going to be agents. Very simple. I would run a report that shows, show me who claimed the R&D credit last year, show me who didn't this year, and those are the ones that we'll send our new agents in to look at. Mm-hmm. So I don't think the answer is as simple as just saying, hey, we're not going to claim it. And I think just the flip side is you may have companies that haven't claimed the R&D credit, should have been, are going to have to wrestle with these 174 expenses and then look for methods to look for ways to offset that increased tax by claiming the R&D credit.
Yep. Yeah, and maximizing the R&D credit will be the way to do it. And again, even with that logic, you're still stuck with it at least a few years acceleration of tax. So it is not a taxpayer favorable issue. It's not a R&D incentive set of rules. If anything, it's a detriment to have these types of expenses. So hopefully they change it in some form or fashion over the next few weeks, months, hopefully sooner.
Yeah, the last thing we want to do is extend returns.
Yeah,
and we want to, you know, one of our calling cards is that, hey, we're going to get this done. We're not going to drag it out. And clients don't like to have their returns extended if at all possible. And but if we see something down the road that may change, you know, I think back to the issue with LIFO.
Oh yeah,
a couple of years last year.
Yeah,
where we thought there was going to be a change.
Yeah,
and we extended returns, and there was no change.
Yeah.
Now what happened this year?
Yeah,
there's change.
Yeah.
So.
Yeah. Yeah, so, but it's all good questions. Michelle, with that, I see we're a bit over our 50 minutes, but I will leave it up to you for some housekeeping. If anybody has any subsequent questions, wants to discuss anything more in detail, please feel free to call any of us here at HBK in the manufacturing niche. We will be happy to help you. The Manufacturing Solutions Group, I should say. So thank you guys all very much, and we'll look forward to seeing you next time.
Thank you.